There is a significant difference between the Head& Shoulders model and the inverted version. It has to do with the dynamics of the trading volume, which plays a more important role in the inverted version of the model. We already talked about how the market can buckle under its own weight. Remember tailspins? At the base of the market, lower or at the bottom, everything is different. A new ascending trend requires a significant increase in pressure from buyers, which is reflected in a greater trading volume. Let's look at this difference from an unusual perspective, the law of gravity. We know that if we drop something, it will fall to the ground. All you have to do is unclench your fingers. But if we try to lift something, we need to make a certain amount of effort. Here's another example for those of you who prefer sports metaphors to physics metaphors. Imagine there is a hill in the course of a long-distance race. If the runner goes downhill, his legs will carry him on their own. But if he has to move uphill, he will need greater stamina to reach the top. As applied to our models, the rule works like this. The market can fall from sheer inertia. An absence of demand or even interest from buyers is enough to push the market over the edge. But inertia will not make the market rise again. Prices begin to rise only when demand exceeds supply, when buyers are more active and aggressive than sellers. In the first half of peak models and base models, the dynamics of trading volume are practically the same. The volume at the head point is always a little less than the volume at the left shoulder. Things change a bit in the second half. In base models, a rise in prices from the head point should be accompanied by increased business activity. Often it exceeds the volume of previous peak from the left shoulder point. A drop toward the right shoulder involves a drop in volume, and a rather significant one at that. The critical movement comes when the neckline is passed.